Now that you have understood fundamental analysis, before we jump in to understand it much better with an example, let's understand some valuation ratios as well. In this session, we are deep diving into the world of valuation ratios. Valuation ratios are fundamental tools that help us assess a company's financial health and compare it with others. They are like vital signs a doctor examines during a checkup. One of the most commonly used ratios is price to earnings ratio, or we call it PE ratio. The PE ratio provides a straightforward assessment of how much investors are willing to pay for each dollar of a company's earnings. It is calculated by dividing market value per share by the earnings per share. For example, if a company PE ratio is 15, this means investors are willing to pay $15 for each dollar of earnings that the company makes. But remember, a high PE ratio doesn't always mean a company is overvalued, or a low PE ratio doesn't necessarily mean it is undervalued. It's all about context and comparison with the industry peers. Ratios never live in silos or in isolation. They should always be compared with the industry peers. Now let's discuss another ratio called PB ratio, price to bookings ratio. The PB ratio compares a company's market value to its book value, which is the value of a company if it is sold off all its assets and paid back its liabilities. Let's take an example. A PB ratio of 1 means the market value and the book value are equal. If the PB ratio is less than 1, the stock may be undervalued. Conversely, if a PB ratio is greater than 1, this might indicate an overvalued stock, but not necessarily so every time. There are many other ratios such as price to sales, dividend yield, and others as well. Each of these ratios offer a different perspective on a company's financial performance and market valuation of the company. But always remember, as I said earlier, every ratio is to be compared with its industry peers. Now, understanding valuation ratios is a crucial step towards making informed investment decisions. They provide a window into company's financial health and can guide you towards potentially profitable opportunities. Now, let's see some of the valuation ratios that as we discussed in the fundamental analysis. The first one being PE ratio. So, if I see P&G's PE ratio, it is 25x. What is a PE ratio if you remember? That is the price to earnings ratio. If you compare its price to the earnings that it earned, it is 25 times the profit that the price is. So this is more applicable for the profitable companies. And there are other ratios also. If the company is not profitable, then how will you calculate the value? Then you can't calculate based on earnings, but you can calculate the valuation or the value of the company based on its revenue. That's called PS ratio. And I'll show that of the P&G as well. That is 4.3 times its revenue. So the value of the company is 4.3 times its revenue, and which is very decent for a stock like P&G, which is in the household sector. And we also discussed in another ratio, that is PB ratio, that is price to book ratio. So compared to its assets, it is 7.9 times. PB ratio, as we discussed in the fundamental analysis, should always be greater than 1. If it is less than 1, that's an opportunity for anybody because that's a very undervalued stock. If a stock is 7.9x for a company like P&G, it is decent again. And As we discussed in the fundamental analysis, no company stays in isolation. It has an industry to compare, it has a market to compare as well. Let's see the comparisons of P&G stock. If you compare PE ratio of P&G compared to its top 5 competitor, top 4 competitors, here P&G is 25x, but the average PE ratio of the other competitors is 36.6%. So here are the competitors of P&G in US market. PE ratio should be lower. The lower, the better. Here if P&G is 25x compared to 36.6, that means the P&G is in a much better shape compared to its competitors with respect to its price. Now let's see how its historical PE ratio varied. It almost went up to 77 because at the time we have seen a dip as well during its in its profits, and now it stabilized around this 25. If you compare it with the industry's PE ratio, household industry's PE ratio is 24, P&G's PE ratio is 25. So more or less similar. So we need not worry much about the PE ratio of P&G. It is in a decent form. So the stock is very fairly priced compared to its earnings and revenue. Now assume you understood fundamental analysis in a much better way by looking at the P&G stock. Similarly, you can go to this particular website, Simply Wall Street, and analyze any company using the data that is available for you in this particular website.